There's a rumor, my dear viewer, whispered like gospel. Checking your own credit score will damage it. Utter rubbish. Complete nonsense. You can peek at your own score every single day, and it shan't budge an inch. And yet, millions believe it, so they never look. They wander through life blind to a 3-digit number that quietly decides whether they get a home, a car, or a decent interest rate. Frightful, really. So let's clear the fog properly. Today I'll show you exactly how credit scores actually work, the 5 things that move them, and the myths that have been picking your pocket for years. Do settle in. First, what even is this number? A credit score is a quick prediction of one thing: how likely you are to pay back borrowed money on time. That's it. It's a trust rating scored from a tidy little formula. The most common one is the FICO score, and it runs from 300 at the bottom to 850 at the very top. Higher is better. Above roughly 740 and lenders rather adore you. Below 580 and doors begin to close. Now, a crucial point people miss: your score is not stored somewhere with your name on it. It's calculated fresh from your credit report, the running record of how you've handled borrowing. Change the report, the score follows. 3 big bureaus keep these reports: Equifax, Experian, and TransUnion. Each may hold slightly different information, so your score can wobble a touch between them. Don't panic over small gaps. Focus on the habits underneath. Right then, the 5 ingredients. Picture a pie cut into 5 slices. The biggest slice, a whopping 35%, is payment history. In plain terms, do you pay your bills on time? This matters more than anything else. One late payment, 30 days past due or more, can sting your score for years. Lenders are simple creatures, you see. The single best predictor of future payment is past payment. Reliability is everything here. So the lesson writes itself: never, ever miss a due date. Set up automatic minimum payments so a forgetful Tuesday can't wreck your number. Even paying the minimum on time keeps this giant slice gleaming and healthy. The second slice, around 30%, is amounts owed, and here lives the most useful idea in all of credit: utilization. This is the share of your available credit you're actually using. Lower is better, far better. Say you have a card with a £1,000 limit and you owe 300. That's 30% utilization. The common rule of thumb is to keep it under 30% and lower still if you possibly can. Why does this matter so? Because someone maxing out every card looks rather desperate to a lender. Low utilization whispers, this person is in control. And here's the lovely bit: it resets every single month. Slice 3, about 15%, is the length of your credit history. Quite simply, lenders trust a long, steady track record more than a brand new one. Age, my dear viewer, has its privileges after all. This counts the age of your oldest account, your newest, and the average across them all. And it's precisely why a piece of advice you've heard is dangerously backwards: closing your oldest credit card. Close that ancient card, and you can shorten your average account age and shrink your available credit in one go. Both can nudge your score down. Often the wiser move is to keep old cards open and lightly used. Slice 4, roughly 10%, is new credit and inquiries. Every time you formally apply for credit, the lender does a hard inquiry, a proper look at your report. A few are fine. A flurry looks alarming. Now, the myth from the very start. Checking your own score is a soft inquiry. Soft inquiries never ever harm you. Hard inquiries from actual applications can ding you a few points temporarily. Big difference. So check your own score as often as you like. Compare lenders freely. Most scoring models even bundle similar applications, say for a mortgage, within a short window, treating them as one. Shop smart, my friend. And slice 5, the final 10%, is your credit mix. Lenders rather like seeing you handle different types: a card here, perhaps a car loan there, all managed responsibly. Variety, handled well, is quietly reassuring. But do not, I beg you, take out a loan you don't need just to chip at this last little slice. It's only 10%. The big two, payment history and utilization, are where the real magic lives. Now to the myth that has cost ordinary people billions, that carrying a balance, leaving debt on your card, helps your score. It does not a jot. That rumor only profits the lenders collecting your interest. You can pay your statement in full every month, owe zero in interest, and still build a glorious score. The card simply needs to be used and paid. Paying interest buys you nothing but a lighter wallet. Another stubborn myth, that your salary is baked into your score. It is not. Your income, your job, your bank balance, none of it sits in the FICO formula. A high earner can have a perfectly dreadful score. For proof, consider how lenders price money. Move from a poor score to an excellent one on a large mortgage, and you can save tens of thousands in interest across the loan. The same house, different number. That is the quiet power of this number. It's not vanity. It's the literal price you pay to borrow on cars, homes, even some insurance and flats. A better score is, frankly, a permanent pay rise. A swift word on a common confusion. You'll meet two main scoring systems, FICO and VantageScore. They're rivals using similar ingredients but slightly different recipes, so the two numbers won't match exactly. That's normal. Most lenders still lean on FICO, but don't fret if a free app shows you a VantageScore instead. The habits that lift one lift the other. Pay on time, keep balances low, and both will rise together. Now, what if you have no score at all? Building from scratch feels like the great chicken and egg riddle. You need credit to get credit, but there are tidy little ladders to climb out of nowhere. A secured credit card, backed by a small deposit you put down, is the classic first rung. Use it for one tiny recurring bill, pay it in full each month, and watch a history quietly begin to grow. Becoming an authorized user on a trusted family member's well-kept card can help too, lending you a slice of their good history. Just be sure their habits are tidy, or you'll inherit their mess instead. So, the turn. How do you actually use all this? Let's make it dead simple. 4 small moves starting this very week that quietly compound into a score lenders will fall over themselves to reward. 1. Pull your free credit reports and check them for errors. Mistakes are surprisingly common, and a single wrong late payment could be dragging you down. Dispute anything that's wrong directly with the bureaus. 2. Set every bill to auto-pay the minimum, so a missed date can never happen again. 3. Pay balances down below 30% utilization, and if you can, before the statement closes for an even better result. And 4. Be patient and leave old accounts open. Time is your silent ally here. A score isn't built in a weekend, it's grown like a garden, watered by small steady habits month after month. And do remember, this is education, not personal financial advice. Your situation is your own. Always verify the specifics directly with the bureaus or a qualified advisor before making a big money decision. Right, onward. Here's your permission slip. You are not stuck with the score you have today. It is not a judgment of your worth. It's a habit tracker, and habits, unlike the past, are entirely yours to change. Run the whole splendid affair back once more. A score from 300 to 850 predicts repayment. 5 slices, payment history, amounts owed, length, new credit, and mix. The big 2 are paying on time and keeping balances low. Checking your own score is harmless. Carrying a balance helps no one but the lender. Your income isn't counted. And closing old cards can backfire. Master those truths, and the number, frankly, takes care of itself. Now tell me, my dear viewer, in the comments, what's the one credit myth you believed before today? I'm frightfully curious. And if this made the fog lift even a little, do give it a like.